Welcome to my video where I dive into top 7 monthly dividend-paying ETFs for your passive income portfolio. These funds can also work well for retirement planning too. While there are many videos on this topic, my goal here is different. I not only want to list the names, but I also want to highlight and cover their pros and cons. And so that way you will have a better understanding which fund suits your needs best. Before we begin, I want you to know how I selected these funds. The thing is that most of the funds on my list are covered call ETFs, and not all covered call ETFs are created equal. Some of them can derail your passive income goals. When selecting these funds, I had one important criterion that I focused on, and that was to avoid as much as possible NAV erosion. It is less of an issue for regular or traditional dividend funds. What it means is that we want net asset value per share of a fund to grow over time, and net asset value per share is more or less equivalent to a fund's stock price. So in other words, avoiding net asset value erosion means that we want fund stock price to grow over time. You may ask, why is this important? The thing is if NAV erosion takes hold, bad things may start happening. For instance, your distributions per share start to stagnate, or worse, they can go down. And let's say if I'm relying on dividend payments in retirement, that's not an ideal outcome. So focusing on NAV erosion and avoiding it as much as possible is the key. Another thing that happens with NAV erosion is that your dividends may not keep up with inflation, and with that, the risk of depleting your nest egg earlier also goes up. So the funds that I show here tend to have lower risk of NAV erosion. It is still there, but it's much lower compared to some other funds, covered call funds, with insane yields on the market. The first monthly dividend ETF is DIVO by Amplify. The expense ratio is reasonable, although it could be better. It's an active fund that invests in 20 to 25 high-quality stocks. Its holdings tend to show both earnings and dividend growth. Most of them are large-cap companies. DIVO's yield stands at 4.6%. While its holdings do pay dividends, a large share of yield comes from selling call options. Unlike many other covered call funds, DIVO does not go after the highest yield. Instead, they write covered call positions on individual stocks on a tactical basis. And what that means is that at a given time, DIVO will not cover the entire portfolio with covered call positions. And with that comes one important benefit. DIVO will let its portfolio ride market rallies without capping the upside too much. Unlike DIVO, funds like GPIQ or QYLD sell covered call options on their entire portfolio. And as they do that, of course, their income gets bigger, but they also at the same time cap their upside. So going aggressively after the yield and selling lots of covered call options will bring more income, but it will also cap that valuable upside and also may even lead to NAV erosion down the road. For instance, in July, DIVO sold call options that covered under 10% of its portfolio. If we look at its covered call positions, we see that many of them are way out of the money. Meaning, yes, DIVO did not receive a lot of premium income from these positions. But should these stocks rally like Microsoft or Apple, DIVO will capture a lot of their upside. The downside of this monthly dividend fund is its concentration at the top. It stands at 50%. Concentration amplifies both gains and losses. Although DIVO is fairly spread out when it comes to sector exposures, financial and tech stocks account for more than 40% at the moment. As for total returns, DIVO did exceptionally well for a covered call fund. The underperformance compared to the S&P 500 is not particularly big. We see that DIVO shined in sideways or down markets, but it lagged in bull markets as expected from a covered call fund. So in a nutshell, nutshell, DIVO does not provide the highest yield, but it strikes a good balance between price appreciation and yield. On top of it, DIVO did not show any signs of NAV erosion. Dividends also showed some growth, and yield on cost almost doubled in the last 10 years. And this is something to like about DIVO. The other fund is DIVO's younger sibling called QDVO. The fund comes with an expense ratio of 0.55% and a yield of around 8%. That's almost double of DIVO. The idea behind QDVO is similar. Invest in stocks to capture price appreciation and income from covered calls. But unlike DIVO, QDVO invests in 20 to 40 large cap growth stocks. Its holdings are your typical growth names like Nvidia, Meta, Alphabet. Like DIVO, QDVO does not sell covered calls on its entire portfolio. That helps this fund participate in market rallies too. Again, QDVO is a top heavy with even higher top 10 concentration at 65%. And as expected, it goes heavy on the tech sector with 44% exposure. The fund is relatively new, so the jury on it is still out. But I expect it to perform like DIVO in relation to its benchmark, which is probably the Nasdaq 100 index. In summary, QDVO does offer high yield, but that higher yield comes with more volatility as well as higher concentration risk. True, its volatility will be higher than for DIVO, but likely lower compared to Nasdaq 100, and covered call premiums are probably at play here. Also, the risk of NAV erosion for QDVO is a bit higher compared to DIVO. Still, because both funds don't write covered call positions on their entire portfolio, that risk is not material. And if we look, for instance, after the April plunge, QDVO's price has recovered its ground and is up. The next monthly dividend ETF is GPIX by Goldman Sachs. The fund charges a very reasonable 0.29% expense ratio. GPIX replicates the entire S&P 500 portfolio and uses covered call strategy for income. Its current yield stands at 8%. To generate this high yield, GPIX goes heavy on selling call options on the S&P 500. In fact, its sold call options may cover up to 75% of its portfolio. Unlike other funds, GPIX focuses on at-the-money call options. These call options tend to generate more premium income, hence the fund distribution yield is high. But sold at-the-money call options come with extensive caps on upside. That's a big negative. But here's the beauty of this fund. GPIX does not write at-the-money cover call positions on its entire portfolio. Instead, it does so dynamically. Depending on the market conditions, GPIX may write cover call positions on as much as 25% to 75% of its entire portfolio. And that percentage largely depends on volatility. As volatility goes up, the cover call premiums go up too. And so GPIX does not have to write lots of cover call positions to generate a certain level of income. So, what happens when GPIX does not cover 100% of its portfolio with covered call positions? Well, if markets start to recover and we are in a bull market, GPIX will capture that upside. In fact, its capture of upside is quite significant, as much as 80 to 85%. That's a lot compared to some other funds that capture less than that, maybe like 60 or 50% at most. Such approach minimizes the risk of NAV erosion big time. Because the stock market tends to trend upwards over a very long time frame, this is a sensible approach. Even though the fund is new, its total returns were strong compared to the S&P 500. Also, GPIX stock price recovered relatively quickly from the April plunge. Again, this shows that Goldman Sachs did a fine job with GPIX. The next monthly dividend fund is GPIQ. It is another cover call ETF from Goldman Sachs that uses similar principles as GPIX, but GPIQ tracks the performance of Nasdaq 100 instead. The fund has a much higher yield ranging from 10 to 12%. Higher yield for GPIQ comes from the fact that Nasdaq 100 tends to be more volatile than the S&P 500. GPIQ is also more concentrated in its holdings and sector exposure as expected. At the same time, historically Nasdaq 100 outperformed S&P 500 on a total returns basis. So if this outperformance continues, GPIQ may outperform GPIX, but of course there's a lot of risk in this comparison. The next fund is SPYI by NEOS. This fund has similar goals as GPIX, but differs when it comes to execution. SPYI targets a yield of 12% with a somewhat high expense ratio of 0.68%. SPYI also sells call options on the S&P 500 index, typically the out-of-the-money ones. This leaves it some room for capturing price appreciation over time. But SPYI targets a much higher yield of 12% compared to about 8% for GPIX. For this reason, the fund has to sell more call options to generate more income. Thus, SPYI sold calls to cover more of its portfolio. More sold call options will naturally cap SPYI upside in bull markets. And to mitigate this problem, the fund takes very active approach to managing its out-of-the-money sold call options. On top of it, sometimes they may even buy call options, and this will allow the fund to participate in those uptrend markets as well as mitigate the NAV erosion risk. If we look at the SPYI stock price, it roughly recovered from the April lows. That's good to see, which shows that its active strategy to capture market upside works. But what if we compare GPIX to SPYI on a total return basis? It looks like GPIX proved to be a better bet to capture market upswings. So long-term, GPIX will likely outperform SPYI given how stock markets tend to go up. But it is conceivable for SPYI to have an edge over GPIX if the S&P 500 goes down for a prolonged period of time. The next monthly dividend fund on the list is QQQI. It is another fund by NEOS with a focus on Nasdaq 100, very similar to GPIQ. But again, there are similar differences. QQQI charges 0.68% fee with a yield of around 14%. The fund uses a similar covered call strategy as its sibling SPYI. QQQI's higher yield comes with a higher volatility, concentration, and overall investment risk. If we compare QQQI to GPIQ, their overall performance has been very close to each other. As expected, both funds underperformed their Nasdaq 100 benchmark. While GPIQ has a lower yield, it was able to make it up by better capturing price appreciation than QQQI. Down the road, there's a high possibility that GPIQ may outperform QQY, and that of course assumes that the Nasdaq 100 index will be in continued uptrend. Of course, if the index stays flat or declines, QQY may actually do much better. Before proceeding to my last ETF, I want to address the dividend frequency. The thing is that going for monthly dividend-paying ETFs has its advantages. It allows you to pay your bills, which tend to be monthly, on time, so it coincides, right? But at the same time, you will have to exclude a large number of other dividend funds that, for the most part, pay quarterly dividends. So this is something to keep in mind. Here's another thing. Dividend frequency does not matter for compounding returns for funds. And that may come as a surprise for many. So hear me out. The thing is that compounding of returns in a traditional sense does apply for, let's say, savings accounts, where your interest gets deposited to your balance, so balance grows and it compounds on itself. But it's a different matter for ETFs and mutual funds. A fund's net asset value per share is approximately equal to its stock price. And a stock price of a fund fluctuates due to many factors that attributed to supply or demand. And when X dividend date arrives and you are paid eventually your dividend, the stock price of a fund may not decline 1-for-1 for the dividend amount that was paid to you, because there are other things at play like supply and demand. But if we control for all those other things and unrelated to dividend payment, the net asset value of a fund does decline by the dividends paid. So if you reinvest your dividends, dividend frequency does not really matter. All you do, you just take the money that was given to you from the left pocket and you plow it back into the right pocket of a fund. So the net asset value of a fund with 100% reinvestment stays the same, keeping other things constant, of course. So this shows that dividend frequency does not really matter for ETFs and mutual funds. And that's a common misconception that I often see people argue on social media. Another thing that I want to address is taxation. If you hold any of these funds in a tax-deferred accounts, it doesn't really matter because anything that you withdraw from those funds when you're in retirement gets taxed at your regular income tax rate. But for taxable accounts, it could be a different matter. For traditional dividend funds like SCHD, qualified dividend tax rates may apply. They range from 0 to 20% depending on your household income. But with covered call funds, the picture is a bit complicated. Many covered call funds tend to generate losses for tax purposes. And it could be even true with that covered call premiums. And as that happens, all the distributions to you will count as a return of capital. And return of capital distributions are not taxed. They will first reduce your cost basis in your investment to 0, and only after that those distributions will get taxed. And how they get taxed will depend largely on your investment vehicle or your fund that you invested, as well as where the stock market dart lands. For funds like GPIX, GPIQ, QQQI or SPYI, their premium income comes from so-called 1256 contracts. And these contracts get taxed at the preferential tax rates. Specifically, that premium income is broken down and taxed 60% as long-term capital gain, and the remaining 40% comes down to taxed as a short-term capital gain. And as you may know, short-term capital gain gets taxed at a regular higher income tax rate. Conversely, DIVO and QDVO don't rely on those 1256 contracts. Instead, they use regular ordinary stock options for their covered call strategies. And those ordinary stock options and gains and losses for them, they don't receive that preferential lower tax treatment compared to 1256 contracts. So potentially GPIX and GPIQ could be more tax efficient compared to those other two. On top of it, GPIX and GPIQ write at the money call options, and in bull markets there's a much higher chance for them to generate losses even with those premiums. So first, those distributions from these funds, in that case, will get distributed as a return of capital in a tax-efficient manner, meaning they will not get taxed and will first reduce your cost basis. Once the cost basis is 0, then we will be talking about that 60-40 split between long-term and short-term gains. And so the final monthly dividend fund is DGRW by WisdomTree. It is the only traditional dividend fund that does not use covered call strategy on my list. The fund charges 0.28% fee and comes with a very low yield of 1.4%. DGRW is a blend fund that invests in a mix of growth and value stocks in the US. For this reason, its dividend yield is very small. The fund selects stocks based on their growth and profitability metrics. Then it weights its holdings on their total dividend payment rather than market cap. That's an unusual approach, which prioritizes the absolute size of dividends. The fund is full of high-quality names like Microsoft, Apple, and even Nvidia. At this time, DGRW gravitates towards the tech sector. The industrial stocks are distant second. The fund will not generate a lot of dividends, but it will give you exposure to growth at a reasonable price, so to speak. The fund did very well for itself compared to the S&P 500. We can see that DGRW held its ground in the bear market, but in bull markets it tends to lack its benchmark. Also, DGRW fund did reasonably well when it comes to payouts. Its dividend grew by almost 8% a year for the past 10 years. Its yield on cost more than tripled over the last 12 years. That's a pretty good outcome. There was no particular order to this list. Different funds may suit different needs. And when I think about comparing these funds, I tend to compare them based on yield and volatility. Here's one way to visualize them. On the left we have Nasdaq 100, the S&P 500 and DGRW. On the right we have covered call funds. With covered call funds, as yield goes up, volatility of returns tend to go up too. GPIX has higher volatility than its SPYI counterpart. This is likely due to more yield from SPYI that shields it from downturns and upturns. The same thing goes for GPIQ and QQQI. DIVO and QDVO are in the league of their own. Their yield is not so high, but their volatility is much lower compared to the the rest of the covered call funds. Conversely, we have DGRW with the lowest yield. Its standard deviation is below this group average. Of course, this entire comparison is not complete. Here I focus on yield alone. Traditional funds like DGRW generate most of their total returns from price appreciation. Goal here was to show that by going for high yield, you traded typically for more volatility of returns. This is especially true for covered call funds, but not so much for regular ETFs. And that's all I have for today. I hope you found this video useful. In my next video, I will compare some of these funds in more detail. In particular, I will compare them to some other covered call ETFs like GPY or GPIQ. So stay tuned for that. Also, like and subscribe to my channel for more content in the future, and I will see you at the next one. All the best!